I said earlier on, we would be diving into a profound topic. Today, we're talking about rent in apartments here in Texas. We're talking about the key drivers of strategic investment when it comes to apartment investment, the key drivers to rent growth in key pockets of places in the Texas market. One of the most basic factors that drive rent growth is the imbalance between supply and demand in the Texas emerging apartment market. The demand for rental housing is growing, as you may already know or have been reading in the news or hearing from the news cast over the media about the Texas market. The imbalances in the supply and the demand ultimately give result to rent growth. Now, housing growth that entails supply is something to keep up with. Take, for example, let's talk about the Austin market, for example. It's one of the most fastest growing tech hubs in the United States of America. Yet the numbers of new apartment development isn't meeting the needs of the rising population out there. When there is more demand than supply, landlords are able to increase their rent due to the scarcity of the availabilities of the units that may be available for people to rent. Now, this trend is especially evident in markets where job growth is rapidly outpacing the rate of new construction. As more people flock to these areas for work, they compete for the fewer units that are available. Yes, which is an option that drives rent prices up. What are the takeaways of this? The key takeaway is that rent growth is driven by the classical demands of supply imbalance. Emerging markets often struggle to build fast enough to meet demand, which would ultimately push up rental prices.